It's a great pleasure to be here in this vibrant and thriving city, and it's a pleasure to talk to you. And I think in terms of the sequence, this fits quite well because I will talk about what is behind some of the key trends that Dr. Rubini talked about. And also I was very pleased with the previous panel, particularly Mr. Kanu's insistence that investors should really think about what is fundamental, what is the driving force behind market movements. Now, I will do this not on a company-by-company basis, but on a macro level, which, as it turns out, is much easier. And it is possible to say something sensible and make sensible predictions based on the data on what the overall markets, and I'm talking about the equity market of a country, the bond market and currencies are likely to do. And the focus is going to be on central banks. And just so that you don't get the impression this is an academic discourse, I produce a monthly research report with forecasts on 40 countries for institutional investors, and I use this also in my own global macro funds that I'm managing with my team out of the UK at Providence Asset Management. And the reports are produced by my research company, Profit Research Center, which I set up in 1998 in Tokyo. Now, the brave new world of central banking has given us a whole set of new concepts and acronyms. There is, of course, the now ubiquitous quantitative easing concept, and I shall talk more about that in a minute. But we have also related and also different concepts that central banks have announced as being now pillars of their monetary policy. The Federal Reserve talked about credit easing, which it wanted to be distinguished from quantitative easing, and the asset purchase programs with a whole set of acronyms such as the TARP program. The ECB joined in producing acronyms. There's the LTRO of over 1 trillion euro injected into the banking system, the long-term refinancing operation, and of course, since late last year, probably the very thing that has calmed worries and led to this spurt of tremendous optimism in equity markets, the OMT, the outright monetary transactions of the ECB. But there's other concepts. The Bank of England has introduced last year the Funding for Lending program, which is now, soon going to complete its first year. And at the forefront, still, the Bank of England is, in fact, the incoming governor of the Bank of England, who's currently the head of the Canadian Central Bank, is talking about a new way of conducting monetary policy by targeting nominal GDP instead of previous inflation targeting or interest rate pegging. And just the very last week, the Bank of England's Paul Tucker suggested that there may be yet another policy tool, namely to impose negative interest rates on banks' reserves at the central bank. Now, this may initially appear a little bit confusing that after more than a decade of tranquility in terms of central bank policy approaches and tools, mainly focusing on interest rates, suddenly we've got this profusion of approaches, and I'll just want to take you through those. What we'll find is that most of them are really PR, marketing talk, without economic consequences. And I shall back up that statement in a minute. But let's start with just two concepts, probably the ones that are most widely watched, the quantitative easing and the credit easing. QE is a concept I actually proposed in the mid-1990s. I started my research in Japan in the early 90s. Remember in 1991, the top 10 banks in the world were still Japanese. It's a long time ago. Interest rates in Japan were at 7 to 8%. Growth was going strong at 7% nominal GDP growth, and the stock market, of course, had fallen quite a bit by almost 50%. The Bank of Japan then lowered interest rates for the first time. And remember, what was the knee-jerk reaction? In fact, all the big investment houses were, and asset allocators were making this prediction: buy Japanese stocks. They're already cheap. Now they're lowering interest rates, and they've got a fairly high level, 7% to start from. So this is going to be boom time for Japan very soon after this correction. Well, that's when I published my first paper back at Oxford University with quite the opposite prediction, that Japanese banks were likely to go bankrupt and Japan was likely to move into the biggest recession since the Great Depression if the right policies weren't taken, because, as I have been saying for the past 20 years, this recession can be ended also very quickly, very effectively, if you take the right policies. What are those? Well, what I called an expansion in credit creation, and I was told this concept is too difficult. I need to think up a new name that people will immediately understand, so I call it quantitative easing. That's my original article in the Japanese Nikkei newspaper, Keiki Kaifuku Ryoteki Kinyu Kanwa Kara. This was the original birth of the concept. Now, the Bank of Japan, from the very first moment, published reports saying this is not going to work. Quantitative easing doesn't work. And then in 2001, as you know, they turned around and said, we're doing it now. We're now implementing quantitative easing. But you see, the difference is they changed the definition. They suddenly defined it as an expansion in bank reserves at the central bank. And already in this very article, I've been saying, here's the list of policies that won't work. Lowering interest rates even to zero won't work. Fiscal stimulation, if it's not monetized, won't work. And expanding reserves won't work. And sure enough, it didn't. So the Bank of Japan, after 5 years of this so-called experiment, said, well, see, we told you, QE is not working, and we're stopping it. So that was clearly an exercise in central bank PR. The substance of monetary policy had not changed. Now, that was very different with the Federal Reserve. Bernanke was part of those debates in the 90s, and turns out he was the one who was actually listening carefully, and he expanded credit creation, which was my original definition of quantitative easing. And he did something that is more successful. He helped the banks to clean up their balance sheets to get them to lend again. And this was done through these asset purchase programs, something, incidentally, and that gets often neglected, the Bank of Japan never did. Something that even the Bank of England has not really done, because they've bought assets not from the banks, but from the non-bank sector, and mainly government bonds, therefore ending up increasing bank reserves, which is really the same thing the Bank of Japan ended up doing. Of course, the results have been much more positive in the US, therefore, implementing what I would call true quantitative easing. And also, they, to some extent, implemented the policy I'd recommend in Japan, and I still recommend. If you have a bad debt problem in the banking system, therefore banks are not lending, you'll get a long recession, you can solve this problem at zero cost to the taxpayer, and that's how you should do it. And this is true for this region when there is a crisis, or Europe, or Japan, or the US. Because you see, what is actually a sort of a financial banking crisis type of crisis? It is merely a problem with the books. It's an accounting crisis. The banks find on the asset side of the balance sheet they have a hole. The loans they've been given, say they're worth 100 originally, suddenly worth only 20. And as we know with banks, equity is less than 10%. You just need a 10% drop in your assets and you're gone. So that's the problem. Well, it's an accounting problem. And since we don't want to upset the accountants, there is a solution without changing the accounting rules. The central bank goes to the banks and purchases all the non-performing assets and those that will become non-performing, which is quite easy to identify, at face value, buys them at 100. They're worth only 20. The banks are immediately solid again. more liquid, stronger balance sheets than ever before. And we have not just shifted the problem to the central bank, because, you see, the central bank is special. Does it have a loss of 80 on this transaction? No. The truth, of course, is it has a gain of 20. Right? If you had a license to print money, it doesn't matter whether you buy it a little bit expensively. Buy anything, you can only gain because your cost is zero. And that's the truth with central banks. So whenever central banks don't want a banking crisis to turn into a recession or a bigger crisis, that's what they do. And the Fed did it. And they solved the problem in record time. And the economy, therefore, as we were predicting, is recovering. The Bank of Japan did this in 1945 when it didn't want a recession. The Bank of England did this in 1914 when the banks were bust. And it was the wrong time to have a recession that just declared war on a number of countries. But things were different, of course, in Japan in the 90s, where the Bank of Japan wanted the recession. But I'll maybe comment on that later. So why did only the Fed adopt the right way of quantitative easing, credit easing, and helping banks to clean up the balance sheets and get bank lending going again? Why the focus in all other countries on expanding reserves when that doesn't do any good? Because reserves is money held by the banks at the central bank, and it's money that's not circulating. And I want to quickly take you through a number of other puzzles that need an answer, and then I want to give you the answers. So we notice this is focused on expanding reserves when actually that in itself doesn't do any good to the economy. And previously, central banks were always talking about interest rates. What was this obsession about interest rates? And at the center of this is the right understanding of how our monetary system works, particularly how banks work. Now, this is what the textbooks tell you banks are doing. Banks are just financial intermediaries. They collect the savings as deposits. They then, in fact, they're very safe intermediaries. There's a reserve requirement, say 1%. So if they get a new deposit of 100, they will give $1 to the central bank and lend out 99. So very safe intermediaries. In fact, intermediaries that can be compared to non-bank intermediation and direct finance, and therefore we don't need to model banks in any particular way. And this is the textbook approach, and many macro models, even central bank models, been adopting this approach. But it's very clear empirically that banks are special. There's plenty of studies that suggest that if you close down particular banks, even though they're theoretically substitutes for those, this will have a negative economic impact. So there's something about banks that makes them different from non-banks and also capital markets. What is it? The puzzle is bigger. If you think about the fundamentals of our system, what actually is money? And what's surprising is that we're never given a proper definition. Textbooks will say, oh, economists agree that money is very important, but they've never agreed on how to measure it. It's much harder to measure money than you think. And here, the ultimate answer from the Federal Reserve, the expert in on the question of what is money, there is no definitive answer to this question. We don't know. Is this really true? Now, bank lending we know is important in the economy, but what explains bank lending? Sometimes it's booming, sometimes it's contracting. Look at Japan. In the 80s, there was a massive bank lending boom. And the only explanation we're given is, oh, it's because of interest rates. They were so low, that's why banks were lending so much. Well, hang on. 2.5%, yes, the low interest rate in the 80s. But in the 90s, interest rates were 2,500 times lower, 0.0001%. And so that doesn't explain why we didn't have a credit boom in the 90s, but we had a recession. Now, some things we do know. And the models are quite right in this. What is driving equity markets? Just linking this also to our market forecasts now. Well, this is where the textbooks are right. that equity markets, here's the Nikkei, one of the hardest markets to forecast, I'm being told, is explained very nicely by the Nikkei is the pink line, by the black line, which is recurring profits, earnings of companies. So corporate earnings are driving equities. Trouble is, by the time you get the data, it's too late. They're coincidental, as you see. So we need to forecast earnings. So that is actually a sensible job that analysts are trying to do. And the question is, how is it possible that earnings growth can be 40% at one stage, and then there can be a 30%, 40% contraction in earnings? So what is driving earnings? Well, earnings can only expand if the whole economy is expanding, so there has to be a link to the national income pie. What is that link? If you plot a graph of earnings with GDP, it's not a very close correlation, because it's the GDP acceleration that's driving earnings, and that's what we have here. So the growth rate of the GDP growth rate explains earnings really nicely. Trouble is, as you see, it's coincidental again, and by the time you get GDP data, it's far too late. So you have to forecast GDP. That, of course, is the age-old job of economists, and famously, they tend to fail miserably in this task. So what is the official story? What's driving growth? And this actually explains why economists fail when they use this official story. The official story is, well, growth is driven by interest rates. And that's why central banks use interest rates as the main policy tool. And of course, how does it work? Well, lower rates stimulate investment and growth. Higher rates slow it. So interest rates are key. They're negatively correlated. They drive the economy. I'll tell you what, there's never been a shred of empirical evidence to support these assertions. They're plain not true. If you look at the data, what you'll find is that interest rates on the vertical axis and growth on the horizontal one are positively correlated. That's Japanese data for the US, positively correlated, any country you choose. And you may say, well, maybe it's the timing. What about the timing? You know, leads and lags, maybe that explains this. Well, exactly, let's look at the timing, look at the time series. What we find is that the economy moves first, GDP growth accelerates. This is Japanese 1987 high growth. With a lag, interest rates then rise. Once growth slows, then interest rates follow. And you may say, well, maybe that's short rates, as we have here in this graph. So central banks are being behind the curve. Surely long rates, the bond market, can't be fooled. Well, look at the most liquid bond market in the world, treasuries, and you see that treasury yields follow GDP growth. First GDP decelerates, then with quite a lag, interest rates fall, and vice versa. So the official story is wrong by two dimensions. We're being told low rates lead to high growth. But actually, what we observe is high growth leads to high rates, low growth leads to low rates. This is different in two dimensions. The correlation and the causation is the opposite. That raises a number of questions, and it's time to come to some answers. What is then driving growth? And we need this to forecast GDP. Then we can forecast equity and bond markets. And why on earth do central banks keep insisting that they use interest rates? Well, recently, this has become obvious that the interest rate story doesn't work when rates approach zero. That's why suddenly we have this spurt of other concepts being bandied about, largely for PR purposes. So in Japan, they lowered rates famously for over a decade to zero. As I warned at the beginning of that decade, that had no impact. The economy failed to recover, growth continued to decelerate. This is nominal GDP growth collapsing. And not because of a lack of demand for money, because in Japan there has been, as in other countries, always demand from small and medium-sized enterprises. And of course the government is demanding a whole lot of money. So where does this obsession with interest rates come from? It comes from theory, not from empirical evidence. And the theory is based on equilibrium. This is a textbook story. What do you need to get equilibrium? Perfect information, complete markets, zero transaction costs. It's a dream world. How do things work on our planet where these assumptions don't hold? Well, markets are not in equilibrium. And when they're not in equilibrium, They're rationed. And ration markets are driven by the short side principle, which says that whichever quantity of demand and supply is smaller determines the outcome. And when it comes to money, it's very simple. Which one is larger, the demand for money or the supply of money? Well, demand is always larger, so the short side is the supply. So the quantity of money supplied determines the economy. Therefore, back to the question, who creates money and who allocates it, and what is money? Is it the government? Is it the central bank? The answer is no. Only 3% of the money supply is created by the central bank, and the government usually creates no money. So who creates 97% of the money supply? It's the commercial banks. That's why they're special. Banks have a license to create money, which most economists still and experts find hard to believe, but it's a fact. Here's how it works. There's no such thing as a bank loan. When a bank receives this deposit, we use this as an example of $100, and there's a reserve requirement of 1%, it'll take the entire 100, give them to the central bank, say that's my 1%. 1% of 10,000. So now the bank can lend 10,000 minus 100, 9,900. You sign the loan contract, they say we have a claim on you, you'll pay back 9,900, the loan, we put it on the asset side. Now you want to see the money, we've put it in your account. How did it get there? We wrote the number, it was invented. That is banking, credit creation. Don't believe me? Check it up. Central banks admit this. Money creation takes place primarily in banks. The money supply is created through bank lending. When banks make loans, they create additional deposits for those that borrowed the money, additional invented deposits. The banks create money themselves. These are Federal Reserve, Bank of England, Bundesbank, central bank statements. Usually in hidden places, they don't want to talk too much about this. So that's our money supply. We have three types of money supply. Cash in circulation, the one that's obvious to the public, but that's 3% in most countries. Then we have the traditional monetarist money supply, bank reserves. They're held by the banks at the central bank, but they never circulate in the economy. So that's not really relevant. And thirdly, we have the real money supply, which is bank credit creation. And that's, of course, also my original definition of quantitative easing. We have to expand bank credit creation if we want a recovery. The quantity of credit is key. You can separate into two flows. Credit for GDP transactions drives GDP. That then determines equity in bond markets, which are leveraged off GDP. Credit in financial circulation drives asset markets and property markets. And that works also empirically, just to show this. So when GDP decelerated, it was preceded by bank credit decelerating. Bank credit recovers first, then GDP accelerates, and of course interest rates follow. And this is then how you can forecast the equity market. True for asset prices. The asset bubbles are simply credit for non-GDP transactions. Financial transactions are not part of GDP. When banks lend for property, it's money creation injected into a fixed market, property prices rise. It's always unsustainable when it's not used productively because it's a Ponzi scheme. So as soon as bank credit growth slows, and before Mr. Canu was saying we need to think about what is the fundamental factor driving these things, these credit cycles, these boom-bust cycles. Well, it is the quantity of credit. And so the next property bust will come when credit creation slows. You can be sure of that. And of course, when credit creation for financial circulation went out of hand, say in the UK, that of course made it obvious that there was going to be a big bust. Relative credit creation of the central banks can be used to explain exchange rates. You see here the yen-dollar rate explained very nicely by the relative credit creation of the Federal Reserve and the Bank of Japan. Now, central banks may not always want stability and growth, as we also recognize with this analysis. In fact, their job is to create cycles, and they're doing a pretty good job at that. So revisiting the central bank monetary policy tools with this analysis, it's clear that most of those acronyms and policies announced aim at expanding bank reserves and therefore completely without effect. Only those policies that expand bank credit have any chance of working. Nominal GDP targeting could be successful if it expands bank credit creation. So conclusion and wrapping up, just give you 3 countries. We follow 38 countries. The outlook for the US continues to look positive. Already over 1 year ago, we were predicting a recovery in US equities and therefore world equities, because bank credit growth has been expanding. You see here is now growing at over 5%, steady growth. So very positive on the US economy, including property. The UK, well, yes, things are getting a bit better, but credit growth is still negative. So we will still see a shrink, well, basically an economy, a real economy that's not recovering in the UK. Japan, credit growth, as we said, over roughly a year ago, was recovering. So we were positive, we're still positive, but there's now so much euphoria in Japan. We need to see the central bank really deliver. We need an acceleration. Bank credit growth is only growing at 1.5%. That's not enough. We need more. And of course, we could continue monitoring monthly 40 countries, and the track record has been quite accurate. I don't look at anything else but credit creation. There's different indices, number of indices for each country, and that can be used also for fund management, such as in the global macro funds that my team and I manage. And I think as an investor, you want to make credit creation, the understanding of how the monetary system works and the mechanism, really a core part of your asset allocation. As Mr. Kinu said before, we need to be aware of these fundamentals that are driving the economy. These are some of the awards we received for our fund management. Now, there's much more written about this in some of my books. New Paradigm in Macroeconomics, which warned of the banking crisis, came out in 2005. Or my book, Princes of the Yen, which tells you about the story from an Asian perspective, which was a bestseller in Japan. Well, thank you very much. I hope we have time for one or two questions.
A quick couple of questions, yeah. At the front here.
Two quick questions. One, what does your research tell you about the outlook for the price of the Japanese yen? And secondly, based on your presentation, can you also comment on the importance of credit demand, not just the creation side, as an offset? Right.
Thank you very much. In brief, the answers. The yen, in order for the yen to fall further, as many people are predicting at this stage, we need the Bank of Japan to expand credit more. Its credit creation has been quite modest. But as also Dr. Rubini pointed out, currencies are always, they're relative things, which is why our currency model has to take two central banks in pairs into consideration. And so Bank of Japan credit creation has been very modest, but because the Federal Reserve has recently, due to the recovery in bank credit, reduced its own credit creation drastically to zero, that's been enough to weaken the yen. So going forward, it always depends on what several central banks are doing at the same time. If we see the Bank of Japan to accelerate credit creation, continue to accelerate it beyond what other central banks are doing, then the yen will weaken further. At the moment, we don't see that. So we're not forecasting significant yen weakness beyond the current levels at this stage, but this is something that can change every month, because on the currency front, our model only has a lead time of between 1 and 3 months, and central banks change their credit creation policies rapidly. On the more fundamental issue, bank credit supply versus demand, it's a fundamental question. My approach to this is, banks in recessions always say, we'd like to lend, but there's no demand for money. This is true for large firms. And go to Japan, the large firms really are not demanding any money from banks. Some are more liquid than banks. The trouble is, though, they're not the main employer in the economy. These are small and medium-sized enterprises, many of which may not be listed, and so investors may not even look at those. They're entirely dependent on bank credit. Now, when you look at supply loan versus demand, demand for loans versus supply of loans, really, you have to look at the aggregate. Now, the aggregate is a horizontal addition of all the individual demand curves, and therefore, because the small firms demand so much money, the aggregate demand for money is very large, even though large firms are not demanding any. You just need one firm or individual to demand, a very large amount of money, infinitely. And of course, your total aggregate demand will be very large. So the supply is always the limiting factor. The supply of bank credit is always the limiting factor, the rate determining factor in the economy.
And we had one more here as well, just up there. Yeah.
Thank you. Thank you for your presentation. And my question is, what are your expectations about the interest rate changes in the near future, the term structure? How would this affect the credit creation activity and then the economic growth?
Right, thank you very much. Obviously, well, a proper answer requires to focus on particular countries because the story is somewhat different because the Federal Reserve has taken different policies. Perhaps since you're looking at the term structure of interest, basically the yield curve, one way of answering this briefly would be just to focus on, say, the US and alternative scenarios. That what people are worried about is now that we've had massive bond purchases by central banks as part of all these, this acronym soup of central bank policies. I mean, that's one thing central banks have always done. They always buy government bonds. We didn't need new names for that. And the worry, of course, is that as the central banks get less supportive, bond markets will not be supported by central bank purchases, and what is the exit strategy? Will interest rates start to shoot up? And, well, obviously, maybe from the short end first, but maybe the long end is going to anticipate that. The solution to this, the ideal solution to get growth started without having the exit problem, which many countries will face, is to have a policy that directly increases bank credit, but in such a way that the banks won't be hurt when the bond market crashes. This was the dilemma the Federal Reserve faced in 1993, 1994. 91, Citigroup and Chase Manhattan were basically bankrupt. They needed a lot of profits. The Federal Reserve arranged that through the bond market, getting the banks to buy the bonds. You had the long end yields coming down and down, basically fueling a bond boom, creating these profits for the banks, so that by the end of 93, a quarter of bank assets were government bonds. So what do you do? What's the exit strategy? Well, what they did then was, when the bond market crashed in February 94, we noticed the banks who should have been hurt had record profits in 94. This has been a puzzle. It's not very well explained by commentators. But at the same time, noticed people were talking about the massive derivative positions of banks in 1993. Bankers' trust, 25 times assets. What was this about? Well, they were shorting the bond market through derivatives. It's not so hard to have exit strategies. So the Federal Reserve, of course, had to give a hint, and that's how you bailed out the banking system then. These policies are still available, but we also have the possibility of doing this in a much calmer fashion. My recommendation, and I've just last week been in Tokyo and spoke to 2 advisors of Mr. Abe, the Prime Minister, reiterating my proposal, and now I think, he's read my book, Princes of the Yen, which is why he's been saying these things about the Bank of Japan. There's a chance they will actually do this, namely the following. This is the solution also for Spain, Ireland, all these crisis countries. Stop the issuance of government bonds. Bond market will love it, of course. No more supply. Right, well, how do the governments fund their public sector borrowing requirement? Well, get the money from the creators of the money supply. Oh, you mean the central bank? No, the central bank only creates 3% of the money supply. It's the commercial banks. Take out loan contracts from the commercial banks. According to the international accounting rules, they do not have to be marked to market. That's the beauty of it. Banks will love it. They can expand their business, earn returns, shore up capital. Credit creation expands. Therefore, nominal GDP grows, the economy recovers, and this is not marked to market. So when the economy recovers, you won't get the problem of, say, if they're holding bonds, a bond crash hurting the banks and then backfiring of the strategy. So, well, This is a long answer to your question, but you see that there are many issues, and it really depends on each country what they're doing. And I'm at the moment optimistic for the US that they will find again an exit strategy which will not damage the banking system and backfire. But other exit strategies exist, and hopefully some countries like Japan will soon take them.
So thanks to Professor Werner for his fascinating presentation. That's the end of the...
Thank you. Thanks very much.